No Nonsense Nonprofits. Hi, I'm Sandy Ray, founder of Sandra E. Ray, CPA, where we alleviate financial headaches so that you can create a bigger impact. Today, we're going to talk about financial reconciliation. Financial management is essential for us to be able to adhere to the legal requirements that we as nonprofits must adhere to, and for just general smooth operation of our organizations. Financial transparency involves accurate financial reconciliations, monitoring our funds closely, and precise reporting. The benefits of this are that we have proper management of funds. We can anticipate cash flows and seasons where we have surpluses and seasons where we have deficits, so we can manage those internally as we need to. And we can produce meaningful financial reports. So, what is a financial reconciliation? In its simplest form, we're taking information from two different sources and comparing them so that we know that both sources are accurate, or what we're reporting in those transactions are accurate. The easiest way to explain this is our monthly bank reconciliations. We take the statement from the bank, we do a reconciliation with the activity in the accounting records. They don't always exactly match. We identify the items where there are differences, if those are just timing differences of when things are clearing the bank versus when they were recording. That's not a problem. But it also helps us to identify issues that we need to be addressed. So reconciliations are a very important part of our internal control procedure. They verify that the accounting records are accurate, and we do that with an outside source. So that just makes us feel much more confident that the accounting records are accurate. It's an important step in identifying errors, preventing fraudulent activity, enhancing the governance with our board of directors, asking them to be involved in this process, like reviewing a reconciliation report so that they can ask questions if they have any, is a great way to get the board involved and have them completing what they need to do to feel comfortable that the financial statements are accurate. Now, these things need to be done on a regular basis. Some of them need to be done monthly, some quarterly, some annually, but they need to be built into our process. And they also need to be completed by the appropriate personnel. So we don't want the person writing the checks to be reconciling the bank statement. That's not always great. That's sometimes why we involve the board in the process. Maybe a board member is the one doing the bank reconciliation. If you're small enough and you need that separation of duties, or you hire an outside service like us, we can do the bank reconciliations for you. So, because we never handle the cash. So that's just a way to make sure that part of our internal control process is being followed, and it's being followed by the appropriate level of personnel. So let's talk about very specifically what accounts we should be reconciling on a regular basis and how often should that happen. And I'm just kind of going to go down the reports like I usually do. I'm going to start with assets, and the first one is cash. Of course, our checking and our savings, we can reconcile those on a monthly basis. Sometimes savings is quarterly, depending on the activity, but we can do that with the statement from the bank. We can reconcile those on a regular basis. If you have a petty cash box, I would say at least monthly, reconcile the petty cash with the receipts. If you go through the petty cash quicker, just every time you need to replenish it, that works as well. But I would say at least on a monthly basis, somebody needs to get in that petty cash box and make sure that the receipts plus the cash in the box equal the amount that's supposed to be there. Investments, again, that's something that we generally look at on a monthly basis. We take the statement from the investment manager, we record the activity, we reconcile the balance of the statement to what's in the accounting records. Some investments, we don't receive a regular quarterly statement. Maybe you're in an investment where you get a K-1 and you're part of a partnership. Some investment managers don't. If you're not going through your investment manager on these things, then we may have to go out to the website and look at what is the fair market value of this stock or this partnership or whatever it is and make those adjustments that way, but use that as the documentation to support the balances on the investment statement. Accounts receivable. Now, many times we'll have donors pledge a contribution in the future period, and we've talked about this before. So we want to make sure that our pledges receivable on our financial statements matches that detailed record from all of our pledges that from donors, say our donor management system, or however we're tracking that. We want to reconcile those two pieces of information. If you have inventory, you want to do a physical count on your inventory and you want to convert that physical count into a dollar value and compare that to the financial statements. If they're way off, we want to dig into why. Was there something that we had to throw out because it went bad or it's obsolete? We need to make those adjustments on the accounting records as well. And then something we don't think about too often is our fixed assets, our computer equipment, our desks, our file cabinets, just whatever you have on your fixed asset listing. We need to go through periodically, maybe annually, and make sure that all those things are there. Sometimes the accounting department doesn't get notified that we got rid of something. We see a lot of the additions to the purchases because they run through the accounting system, but sometimes something became obsolete and we donated it to another organization, or maybe we just threw it in the trash, or maybe we sold it. We just need to go around and make sure that what we have on our listing still exists. And if it's not there, that there's a reason for it and we've accounted for that in the accounting records. Looking at our liabilities, of course, the first thing that comes to mind is our credit card. We're going to look at that statement that we get from the credit card company on a monthly basis and reconcile that to the accounting records just the same way we do with our cash accounts. And then if you have payroll, you may have some payroll accruals related to payroll taxes, the payroll itself if you're an accrual basis reporter, or you may have payroll liabilities related to, say, retirement or health insurance or something like that. We want to take those payroll records and make sure what we think is due to these organizations like the IRS or the health insurance vendor, and the balance that is due is reflected on the financial statements. So we want to look at that periodically and make sure that that agrees. And then finally, as liabilities, we all have leases and notes payable. We want to agree those to our amortization schedules. And that's just splitting those payments between the interest and the principal portion according to that amortization schedule that we have. Sometimes they need to be adjusted because payments are made early or late, or maybe we're making additional principal payments on our EIDL loans, which I highly recommend. So we just need to make sure that the balances agree to the support documentation that we have on our amortization schedules, which of course tie back to the original loan or lease document. And then finally, on our statement of financial position, we have net assets. And specifically, I want to talk about the net asset roll forward. And that is it's an accumulation of our restricted contributions and our expenditures. So we take our beginning restricted number from last year. We add to that any new restricted contributions that we have. And then we subtract from that any expenditures based upon those restrictions that we're allowed to apply to that grant or that restricted donation and come up with an ending balance. And we want to make sure that all that ties out. We need to do that roll forward, that reconciliation of beginning and ending balance. Now, many times we do this on an annual basis, but if you don't have an internal process to track grants separately, maybe you want to do this on a monthly basis, just so where you are with your grant balances. And then moving on to our statement of activity, I want to talk to you about revenue. Of course, the first thing that comes to mind is contribution revenue and reconciling that to our donor management software. We can run a report out of each. They should match. Maybe there's a few timing differences, but they should generally match. But we want to pay close attention again to our restricted revenue. Are we accounting for that properly? But additionally, this is a great way to make sure we're accounting for our non-cash contributions. Generally, we're pretty good about putting those in the donor management software, but not always getting them in the accounting software. So we want to pay attention to those non-cash contributions so that we get them recorded in both places. And this is a great way to make sure that that's done. Other income, like investment income, we can tie to our investment statements. Generally, there's a year-to-date income on our investment statements that we can easily look at our accounting records. Program service income. Do we keep some sort of statistical basis information externally from the accounting process where we can take that statistic, convert it into a dollar amount? Say we charge $10 for a certain service. How many times did we perform that service? Multiply it by 10. Is that our program service revenue? That's an easy way to look and see that we're getting all of those transactions recorded. And then budget variances. Don't think about budget variances very often when it comes to reconciliations, but when you're looking at your actual revenue versus your budgeted revenue, and there's an amount that is a material difference, we need to reconcile that difference. We need to find out why there's such a material difference. Was it something that we didn't anticipate, or when we were doing the budgeting, is it something new, or did we anticipate doing something that we decided not to do at a later date? Or is it just that the cost of that item is turning out to be more than we expected? Maybe it was travel for one thing, groceries for another. These are many things that are going on that we just need to look and make sure that we are investigating those differences. And then that way we can report to the board why, and it enhances their governance of our organizations. And then moving on to expenditures. The first one I want to talk about is salary expense. It's very easy to tie our salary expense to an external document from our payroll processor, like a 941 form. 941 form gets reported to the IRS. It has our total salaries for the quarter. It's very easy to add up those salaries from the 941s and compare it to our salary expense. If you're accrual basis, you may have a few accruals you have to adjust for, but those are usually pretty easy to do. And then for expenses, do we have any documentation that we're generating within our organization, but not by the accounting department? For example, special events. Many special event planners will keep track of their expenditures to make sure that they're not going over budget. So when that event is over, take that documentation that the special event planner has prepared and compare that to the accounting records. Same for grant expense tracking. Grants managers many times will keep separate listings so that they know exactly where they are with spending down those funds. So let's compare those. Sometimes the grant manager misses something, sometimes the accounting department misses something. It's a great way to keep both sets of records very accurate. And then finally, on the expense side, again, those budget variances, same thing we talked about before. So as nonprofit organizations, we are subject to so much scrutiny, it's sometimes overwhelming. We have different fiscal year ends, we have restricted versus non-restricted, and we have a ton of different reporting requirements. So you have to be organized and your accounts have to be accurate. And to feel confident in your financial reporting, one of the most basic ways to accomplish all this is to reconcile your accounts. Do it regularly, build it into your internal control systems, your processes. This has to be provided with this report or whatever. Hold each other accountable. This is going to make things more easier to do in the long run. It takes a little bit of time to do these things, but in the long run, it saves you a ton of time and a ton of headache. So I hope this was helpful. And if you have any questions regarding this topic or any other topics you'd like us to cover, please put something in the comments. And as always, we appreciate your likes. I want to thank you for joining me today. And remember, that creating a bigger impact starts with stopping the nonsense. If you're dealing with nonsense in your nonprofit organization, we'd love to help you cut through the noise.